Hello and welcome to another episode of Investment Acorns, our exclusive series featuring insights from Whiteoak Capital Asset Management Limited. Now joining me today is Manuj Jain. He's Head of Products and Strategies at Whiteoak Capital AMC. Welcome Manuj, good to have you back with us.
Thank you so much.
With Manuj, we'll be talking about two of his columns that he's written for the November issues of Mutual Fund Insight and Wealth Insight. Now starting with your column in Mutual Fund Insight, what is long-term in SIP? So basically, it is a very subjective thing. Long term can be a month for someone, can be a year for someone else. But in terms of investments, what really is this long term, and why is understanding this horizon critical for investors?
So you rightly said, Ruchita, that it is very subjective, and many a time we see in newspaper and television experts explaining and asking investors to be long-term,
right,
investing for the long term. But what actually is long-term? Because if we don't put a number to it, it is very difficult for investor to understand it. Like you rightly said, somebody may take a understanding that long-term in 3 years, and after 3 years, he or she may be disappointed looking at the kind of experience they would have got. So we did this analysis for last 28 years of data of Sensex TRI, and that too on a rolling basis, so that we get a fair picture on a monthly rolling basis. So this analysis is basically telling you that if you are doing an SIP for, let's say, 3 years, so over the last 28 years, 80 or 85% of the time, your returns are positive, at least positive. So let's take positive as one measure.
Okay.
And about 56-57% of the time, a 3-year SIP has delivered some 10% plus XIRR. So let's take another number, which is 10% is a good number. Double-digit return is a good number to work with. So which means if 56% of the time returns are more than 10%, 44% of the time returns are less than 10%, which may not be very exciting enough for most of the investors, including me.
Especially equity investors.
Especially equity investor. So this analysis is basically telling you that if you are investing for 3 years, you should be okay that there will be a 3-year period when your returns will be negative also. Okay. Because only in 84% of the time approximately returns were more than 0%. So there are 16% of the time returns were negative, like during COVID, or for example during 2008. So if you are looking at your 3-year SIP return in October 2008 or March 2020, most likely they were negative. But if you increase your time horizon to, let's say, 8 years, then at least in last 28 years, a 8-year SIP has delivered positive return 100% of the time till date. And the probability of making more than 10% XIRR for an 8-year SIP is about 84%. If you increase your time horizon further to 10, 12, 15 years, obviously 100% of the times, at least in past, returns were positive. The probability of making 10, 12% return goes up by up to 96, 97, 98%, okay, which is a reasonable number. Right. Yeah. So I think if investors are starting SIP, they should at least start SIP for 8 years, if we look at this data at least. And they should be okay increasing the time horizon for another couple of years if required, because this may happen that their 8 years is getting completed on March 2020. Right. So they should be okay. They should have some flexibility. So you should have, to answer your question, investors starting an SIP, they should have long-term time horizon in their mind. That time horizon can be 8 years for simplicity, but they should be okay to take it to 9 year, 10 year, 11 year if required.
All right. Now there's another question which we often get from investors, from a lot of our subscribers as well. What should be the date of their SIP? Is there a magic date that can guarantee returns?
So again, this is a very famous question, and everybody try to maximize their return experience, and hence this is a valid question. But again, we try to answer this question with the help of long period data. Otherwise, everything is subjective. So let's put some objectivity in the form of data. Again, we did the analysis for last 28 years of data, and for simplicity, we have taken 10-year SIP period as a benchmark. That if somebody is doing a 10-year SIP over the last 28 years on a rolling basis, that somebody would have started SIP 28 years back, 27 years back, 26 years back, and everybody is doing SIP for 10 years. So this data is telling you that whether you are starting SIP on 1st of the month or 2nd of the month or last working day of the month or mid of the month or last Thursday, which happens to be expiry date, and a lot of people have this view that if your SIP date is closer to the last Thursday because it is one of the most volatile week, so you will get more benefit because you will get more rupee cost benefit for your SIP, but that is not true. Data is suggesting you that you pick up any date, the return difference is up to second or third decimal point, okay, which is insignificant. Also, if you do this analysis after 2 months, let's say today you are getting the result is that on first you are making highest possible return, and that to second decimal point highest return. After 2 months, you will realize that 15th is the best date. So this date will also keep on changing. So in short, it doesn't matter. If you are doing a 10-year plus SIP, it doesn't matter. You pick up any date which suits you. Like if you are somebody who is salaried, and typically you are getting your salary in your bank account around 30th or 31st of the last working day of the month. I think first or second working day of the month, next subsequent month should be that SIP date you should pick.
Convenient also.
Convenient, which is whatever is convenient to you.
Yeah. Now comes the frequency. Daily, weekly, monthly. What is your recommendation there?
Again, there is this myth that if you are doing a daily SIP, you are getting a benefit of volatility in the market and you are doing better averaging. Again, the long period data suggests we have taken 28 years data. Okay, if you would have started monthly SIP 28 years back, or weekly SIP 28 years back, or daily SIP 20 years back, the returns are same.
Okay.
Only second decimal points returns are different. Then the question is, what should I do? First of all, it all depends upon you. If you are somebody who is salaried, I think you are getting salary once in a month, you can do monthly SIP. If you are somebody into business and you want to save small amount, or you are an entrepreneur or a shopkeeper, you want to save small amount daily, you can do daily SIP. But if you ask me my personal preference is you should not do daily SIP. Okay. While the popular belief is that you should do daily SIP, my belief is that you should not do daily SIP. I'll give you a simple example. Because of my job profile, I'm lucky enough to meet lakhs of investors over the last 17 years. And I came to this conclusion that most of the investors who are doing SIP, they do SIP at least in 4 to 5 schemes. Nobody is doing SIP only in single scheme. Let's say somebody is doing in 3 scheme, 4 scheme. So let's take 4 scheme. And let's say we are talking about an investors who is doing SIP for 10 years. So let's say I'm a investor doing daily SIP for 10 years in one scheme. That means on a 1 month basis, there will be at least 20 to 25 transactions in my bank account for that one SIP, which means in a year, there will be 250 transactions for one SIP. And I'm doing 4 SIP. That means there will be 1000 transactions in my bank account. And I'm doing this for 10 years. So there will be 10,000 transaction in my bank account. I think it is totally avoidable because it is a complete mess you are creating in your bank account for no reason. If you are getting higher return, I would still agree. Okay, you keep on doing daily SIP and you do 10,000 transactions in your bank account, but it is serving no purpose. Versus what I'm suggesting, let's say if you are doing it for SIP, you do it on a monthly basis. One SIP can be on 7th of the month, another can be 14th of the month, another can be 21st of the month, and last can be 28th of the month. So every week, some amount is getting debited. So it is kind of weekly SIP. Or in monthly SIP, there will be only 12 transactions in a month. Okay. And on a yearly basis, it will be like,
on a yearly basis, there will be 12 transactions.
Multiplied by 4. Which means 48 transactions multiplied by 10. We are doing it for 10 years. So 480 transactions. You are getting a rupee cost averaging benefit. You have reduced number of transactions to 480 versus 10,000. So my personal view is that I just hate daily SIP.
Now, another interesting observation that you make is that as the investment horizon increases, volatility goes down. Can you explain why does that happen?
Yeah, because like take this first study we did for what is long term. So when you are doing an SIP for 3 year, 4 year, 5 year, there will be events. Sometimes your SIP is getting closed at a time. I mean, the tenure is getting completed at a time where there is some uncertainty and your experience may be not the kind of experience you would have expected. But when you increase your time horizon to 5 year, 8 year, 10 year, there will be events and everything will be averaged out. So because of events happening and some positive events happening in a long period of time, some negative event taking place during the entire tenure of your SIP, everything will average out and hence volatility goes down. We know that equity can be very volatile on a yearly basis, but on a 10 year, 15, 20 year basis, we know that the volatility goes down and the returns are closer to the average return. In 1 year, equity can go up by 50-60% also. It can go down by 50% also. But when you look at 10-year data on a rolling basis, you know it will be closer to, let's say, 12% or something like that, which is closer to the nominal GDP growth. So this is the reason.
Okay, all right. Now, what would be your advice to SIP beginners to help them stay realistic and, achieve their goals?
I think the first thing is that you should be clear in your mind that whether you are starting a 3-year, 5-year, 10-year SIP, you should be flexible enough. Sure. Because you can't control everything. There are things which are beyond any investor's control. There are events which are not only local but global also. There are geopolitical events, and these events can coincide with your tenure completion. And hence you should be flexible enough that if at the end of my tenure, there is some event which is beyond our control, some negative event, I should be flexible enough to increase my time horizon. Even if you are not making top-up investments, you should stay invested for some more time, because these things will eventually cool off and market will revert back to the mean return. So I think first of all, you should not wait. If you are planning to start SIP, you should start immediately. You should not wait for the best time. I think in one of our conversation earlier, we covered that it is futile activity to wait for the best time, because you should start immediately so that you get the best compounding benefit. The sooner you start, the better compounding you can get. Secondly, you should be flexible enough that if required, I should increase my time horizon, maybe by 1 year also.
And ideally for the long haul. Okay. Now moving on to your column in Wealth Insight, where you explore the tug of war between value and quality style of investing. So why do you think these two styles, they keep outperforming each other over different time periods, and what drives each one of them to outperform the other?
So let me first explain you that what is our understanding about value and quality. So there are certain businesses or stocks which are categorized as value stock, and certain stocks are categorized as quality stock. Typically, low PE, low PB, or high dividend yield. These are few metrics to measure whether a stock is relatively undervalued or overvalued. I mean, there can be various other means, but these are most popular ones. So stocks with low PE relative to their industry and relative to their peers are called value stocks. And stocks which are generating high ROE as compared to their peers, and their balance sheet is very strong, which means they are less leveraged, and their profit variability is low as compared to the other in the industry, are called quality stocks. So you see, value stocks, because they are kind of undervalued, low PE, versus quality, which is typically high ROE, solid balance sheet, and low leverage. So you can expect that on a relative basis, quality stocks will have higher PE. So in a way, to some extent, they are sitting at a two different extremes. So there are times when there is too much uncertainty in the market, like calendar year 2011, 13, 15, 18, recently 2020, because of COVID, there was a lot of confusion. Whenever there is confusion, people or investors look for stability, uncertainty. Obviously, there is nothing called 100% certainty in the stock market, but still on a relative basis, you look for certainty of cash flow in the business. And quality, as we just discussed, quality stock demonstrate better stability and better predictability in terms of their ability to generate cash flow. So we have noticed that during uncertain time, quality as a theme do well, but during bull run, okay, like the kind of bull run we have seen in last 4 years, 2021, 22, 2023, people look for undervalued stock. They want to make the highest possible return. They are less worried about the beta of the stock or the volatility of the stock. They just want to make the highest possible return. And hence, during this period when there is some certainty and people are looking to maximize the return potential, they go for value. So yes, these two themes are kind of contradicting than each other, and at depending on which kind of scenario we are in the economy, different style work.
Okay, now your data also shows that winners rotate between, as you also mentioned right now, winners rotate between quality and value. So for investors, what does it mean in terms of strategies? So, and should they stick to one style or go for a blended approach? So
it all depends on individual investors' objective. Like some people like to take tactical call that basis on available information, they want to decide which segment of the market can deliver best possible return, at least in their mind. So those investors can decide that, okay, we have seen that there is a 3 or 4 years of one-way rally in the value theme, and things are moving in such manner that it looks like to be that over the next 3 years, quality should do well. So investors looking to take tactical call may use this information in their advantage and decide whether they want to position their portfolio towards more value theme or versus quality theme. Second, the investors who are least bothered about taking tactical call, I think this data is basically telling you that you should create a balanced portfolio. If you are somebody, for some reason, let's say you started investing 4 years back, 3 years back, and unconsciously most of your investments are made towards value style of investing. There is a category also, a SEBI defined category in mutual fund, which is called value, which did exceptionally well over the last 3-4 years. So if unconsciously you have made your portfolio tilt towards value, I think it makes sense, at least now, that you incrementally add quality portfolio in your portfolio, quality schemes in your portfolio, so that you can maintain a balance. Otherwise, your investment journey can be very volatile. There is no harm, by the way. You can stick to value theme for 10, 12, 15 years. You can stick to quality theme. Both these themes over the time should generate decent return. Only thing is about the investing experience on a year basis. So if you tilt your portfolio towards one particular factor too much, you should be ready with too much volatility in terms of alpha.
To improve investing experience, could you explain what a factor-diversified portfolio looks like and how can investors create one there?
So there are two ways. First, while picking a fund house or fund manager, you can pick a fund manager who is known to create a factor-diversified portfolio. You can easily figure it out by listening to his commentary or interviews or reading about that fund house, that what is the fund house philosophy. So you will find that there are certain fund manager who are very good, but their tilt is towards value. There are certain fund manager, again, they're very good, but their tilt, natural tilt towards quality. Second, there are certain fund managers who are openly in all communications are telling you that we like to create factor diversified portfolio. So the first approach investor can pick is that they pick a fund manager who is openly and in writing telling you that we create a factor diversified portfolio. Second, what you can do, you can pick and choose fund managers who are good in particular style. So like you pick a best possible, at least in your mind, best possible fund manager who is following a value style. And then you pick another good fund manager who is basically has a good experience and demonstrated again and again that they can pick good quality stock. And again, you create a portfolio by diversifying in these two fund managers. So both approaches are good. It all depends on how you, it all depends on your convenience.
Okay. Now, at the end of your column, you've cite this football analogy, that positioning where the ball will be rather than where it was. It's quite interesting. Could you elaborate on how investors can apply this thinking to spot emerging opportunities rather than, chasing past returns?
I think this analogy we made especially for those investors who take tactical call. And we are not talking about those investors who are investing for long term and they are sticking to maybe diversified flexi cap strategy. They should do that. They should not worry about anything. But those investors who take tactical call on themes, on sectors, on styles. So you see SEBI data, AMFI data tells you that over the last 12 months, almost 40% of the flows, net as well as gross flows, are going to thematic category. Further, if you are a keen observer of equity market and mutual fund industry, you will realize that bulk of the flows the thematic categories are receiving, these themes are very hot theme. For example, let's say in hindsight, we can say defense, manufacturing, or let's say high beta strategies, metal, etc., or manufacturing. And these strategies did very well over the last 3-4 years. Now, the whole idea about this phrase, winners rotate, is that winners rotate, and the theme which did good in past may not do as good in the future. Most likely, they are going to underperform, at least if history is telling us something. So the idea of making this analogy is that you should not look at past return only when taking tactical call. If at all you are looking past return, you should look for those themes which did poorly and then position yourself. Rather, you decided, okay, defense did very well over the last 3 years, so I should invest in defense. It should be the other way around.
What would be your advice to long-term investors? How can they stay focused on their goals?
I think first realization that whenever you take call on anything, any narrow segment of the market, see, market is an amalgamation of various factors. Right. There is about 50% of the stock in BSE 500, you can call them growth. 50% of the stocks you can call them value. About 30% of the stocks falls in PSU basket, remaining 87% non-PSU. Likewise, there are certain sectors which are cyclical in nature, then there are defensive sectors. Certain sectors drive most of their revenue from outside India versus domestic sector. So index is an amalgamation of various factors. If you bet on one particular factor, that let's say that factor can be PSU. Okay, I like PSU, I will only invest in PSU, which means you are only targeting 13% of the market. Likewise, if you are telling I will only invest in value, you are only targeting 48 or 50% of the market. So if you target a very narrow segment of the market, you should be aware that there will be a lot of volatility in alpha. There will be years you will outperform the broader market by a huge margin, but there will be years you are going to underperform. Like take example of PSU. For years and years, PSU kept on underperforming. Only after, only recently in last 3 years, they made a comeback. Right. So the narrower the theme, the more volatile experience will be there. So if you are taking a tactical call, I think my suggestion is that you take tactical call with very small amount of your total surplus money, rather investing your entire amount in one very, very narrow theme. Secondly, to improve the consistency of your performance versus the benchmark, I think it makes sense. Either you invest in factor diversified portfolio or create a factor diversified portfolio.
All right. Thank you, Manuj, for sharing your insights and, diving deep into your columns with us. We look forward to having you again.
Thank you so much for inviting me.